Hi, this is Adrian Larson, President of Pathlight, here with your Pathlight Insight. And today we're going to play a summertime version of one of our favorite games, Perception versus Reality. If you've been reading the news or watching it on TV, you might feel like we're in a full-blown trade war at this point in time, with the latest headline being that Harley-Davidson is going to have to move some of their production over to Europe because the European counter tariffs are going to impact them negatively and they cannot pass that cost on to their consumers over in Europe. Well, the reality of the situation is vastly different. If we look at the overall economic activity in the United States, the Atlanta Fed is tracking right now to roughly 4.6% in GDP growth in the second quarter. And so we've accelerated off of a roughly 2.2% first quarter GDP rate. We also have earnings coming up, so companies will be reporting these second quarter earnings. Right now, estimates are calling for a 19% year-over-year growth in earnings. That would be the second fastest growth since the first quarter of 2011. One additional piece on that earnings front is that throughout the quarter, earnings estimates have actually risen. So analyst expectations on March 31st were for an 18.6% earnings growth in the second quarter. We've now actually increased to 19%. So those numbers are holding. They usually start out higher and come down as we go, but this economic move in the United States continues to be strong. So we want to make sure that the emphasis is on what is actually happening rather than what's being talked about, the trade tariffs, this trade war, the pieces that are actually impacted is a very small part of overall global trade. Yes, it has the potential to get out of control, but right now the reality of the situation is that it just isn't. So we want people to focus on what are the strong fundamentals, continued fundamentals. If you look at the stock market, especially in the United States, we are not portending some major disaster economically. Stocks are down roughly 4.6% since the January highs, but the S&P continues to be positive for the year, up roughly 2.8%. Now the Chinese index, the Chinese stock market, is down over 23% from its highs in January and is down roughly 17% on the year through June 25th. Of 2018. So you're seeing where the actual negative impact is. It's in Chinese stocks, it's not in US stocks. So please, again, focus on those solid fundamentals for US companies. Now, just as an aside, a tidbit, a little bit of trivia. General Electric has been kicked out of the Dow as of June 26th. This was a founding member of the Dow. Things have changed quite radically for General Electric, but just as some information for you, it had a 111-year consistent run in the Dow. It has come out now and been replaced by Walgreens Boots Alliance. As a trivia question, what's the now longest tenured Dow company that's still there? I'll give it a pause. Chevron, 1928 is when they entered the Dow. Just a little bit of summertime trivia for you. If you have any questions or want to talk about anything, please don't hesitate to reach out to us. Take care.